Hello, good morning everyone. Welcome, a very warm welcome indeed to this, our Duncan and Topless webinar on the 2023 Autumn Statement. I'm delighted today that I'm joined by our panel of experts. I've got Rebecca Bright, Tax Director in our Private Client team, Head of Trusts, Christine Newitt, Tax Director, Head of VAT, and Matthew Appleyard, Tax Director, Head of Corporate. Before I allow them to present their views on the Autumn Statement, I thought we ought to just settle some timings and then a bit of an overview from me. I'm your host for this morning. My name is Nicholas Smith. I'm Head of Tax here at Duncan and Topless. We plan to be away by 11:30, an hour and a half's time. We won't be any longer than that. After we've had our panel of experts speak, I'll allow time for questions. There is, if you can find it, a Q&A box up on the right-hand corner of your screens. Please post your questions there, and we'll have time at the end for those, and we'll see what the experts have to say about those. So as I said, I'll just give a little overview on what I thought to the autumn statement this year. Or was it an autumn statement, or was it a budget? There was a time when we had a budget purdah, and before chancellors spoke in the House of Commons, that they wouldn't pre-announce things, which in my view actually made quite a lot of sense. This time, what did we have? A month ago, Jeremy Hunt was saying that this was an autumn statement, and as usual, it would be about government spending. There would be no tax changes. Only just over a week ago, his Prime Minister, Rishi Sunak, gave an announcement saying there would be changes in tax, and we saw last weekend all sorts of tax changes being revealed, and indeed that's what we saw on Wednesday when we listened to Jeremy Hunt give his autumn statement. It's a strange way of going about things. I mean, he's been fortunate in many ways of having set frozen thresholds, I suppose, in order to create what chancellors call fiscal drag. This is where by freezing thresholds, inflation naturally provides more tax receipts, and the government have been, I think, a little surprised in terms of how inflation's affected that, and given us huge tax receipts they weren't expecting, which has given them, you might say it's given them a little bit of wriggle room and agility to change their plan. It's not quite my view of the situation, but let's just see, because when on Wednesday Jeremy Hunt announced his autumn statement, he talked about having 110 growth measures for business. This was billed as an autumn statement for business. I don't know how, and I've given you this slide in terms of just entitled complexity. How we're supposed to see through that and sort of assess what impact that's going to have on the economy over the next 3 or 4 years. It's really difficult to see. Lots of small changes, perhaps. And as I said earlier, maybe that's part of being agile in terms of making those short-term decisions. But it rather seemed to me to be a strange way of going about things in terms of, was it all about political rhetoric and electioneering rather than really addressing the issue? The issues remain, and obviously I won't go through those, but what I'd like to do is identify a couple of points where I can see there being perhaps problems stored up for the future. And the first one I want to just touch on is about pension scheme relaxation. Jeremy Hunt talked about unlocking pension funds for high growth companies, and in doing so, allowing pension schemes to grow more. So you can see the benefit that benefits the growth companies, and it also benefits individuals' pension schemes. But is there a risk in this? It worries me that could be open to abuse. There's a very good reason why there are very strict rules around pension schemes and people's inability, I suppose, to defraud other people. It worries me we might have a situation where actually pension schemes don't grow, but actually disappear. The other one I'm concerned about is something that happened in the 1990s, which was when we had film scheme reliefs. These were announced again. Jeremy Hunt referred to the fact that Barbie was produced in Watford and that the government would seek to encourage the film industry in this country and allow more tax credits. And I just fear that once again, we as an industry are very good at seeking those little loopholes. And I fear that, I mean, the 1990s is a long while ago now. It's over 30 years ago since these were first introduced, but memories can be quite short. And it worries me that we might have something that we're just creating trouble for the future. There are still taxpayers now that entered film schemes in the 1990s that are still dealing and negotiating with HMRC. Doesn't bode well for the future for me. So what's my overall summary? Well, I'd like to say that the helium balloons I've chosen are for growth, but the growth numbers are not great. Even though there's been some wriggle room for the Chancellor this time, we're still predicting growth of less than 1% for this year and next. It's not even 1.5% for 2025. And for the remainder of the economic cycle up to 2028, still doesn't average 2%. That's not great growth. So instead, what I fear is that we're creating more inflationary pressures. Let's take, for example, the universal credit, which will go up by 6.7% in April next year. This is normally based on the October inflation figures, which were 4.6%, something that the government are incredibly proud of, having halved inflation over this year. But they based it on the September inflationary figures of 6.7%. On top of that, we've got state pensions. Those in receipt of state pension will be delighted to hear that their state pension will go up by 8.5% next year, substantially above the current rate of inflation. And then we've got the national living wage, which was announced as going up by 9.8% to £11.44 an hour. That's fantastic for those people on low wage. Might not be so great for those businesses that are perhaps in the leisure industry or retail or even agriculture, where low wages are paid. That's going to put tremendous inflationary pressures on businesses and hence our country. So overall, I fear that we're creating inflationary pressures. And looking forward, what will that mean when the Bank of England next sit down to consider interest rates? Well, if there are inflationary pressures, they're likely to keep them high. And I wonder whether the tax giveaways that were announced on Wednesday might well be overtaken in people's individual pockets when they look at their mortgages and their borrowings. So overall, I feel that perhaps too much electioneering and rhetoric. Interestingly, I noticed this morning that the Conservative Party have had a 4-point poll boost as a result of the autumn statement. So perhaps that's what it's about. We know there'll be a general election next year, and perhaps then we'll see a bit more of this when we come to the budget in 2024. But let's not get ahead of ourselves. We need to think about what happened on Wednesday, and that's now I'm going to ask our panel of experts to come in. I'm going to start with Rebecca Bright, who will now give us her insights into the impact for our private clients. Over to you, Rebecca.
Thank you, Nick. I'm just going to share my slides. So, as Nick's referred to, I'm going to concentrate on the private client impacts from the budget. I'll just have a quick trot through some of the main headlines. So, excuse me. Talking about personal allowances first, the amount that many taxpayers can earn tax-free, and there's been no change to these. So we're still at, for the current year and the following tax year, £12,570, plus the other sort of small allowances that are available. Looking then at income tax rates and tax bands, again, no change to these. We're at the figures previously announced, and as we can see, the same for 23-24 and 24-25. Just as a reminder, from April 22, we had an increase to the dividend tax rates. So just as a recap, the basic rate is 8.75%, higher rate 33.75%, and additional rate 39.35%. And also the dividend allowance, as previously announced, it has been at £2,000 per year since April 2018. From April this year, it reduced to £1,000, and then from next April, it reduced to £500. So as a reminder, this is the amount of dividend income you can earn tax-free. This is in addition to your personal allowance. Now, one of the main sort of talking points from Wednesday was the cut to national insurance. So looking at an employed individual first, as we can see, the headline rates for the employer haven't changed. And if you're an employee paying or sort of earning in the band 12,570 to 50,270, earnings in that band will now be subject to a 10% employee national insurance rate. Now, national insurance contributions give you entitlement to certain contributory state benefits, the sort of main one being state pension. And so for an employee who's a higher rate earner, so earning fully in that band 12,570 to 5270, got about £37,000, which is subject to 10%, so 3,700 odd pounds. We'll come back to that point in a moment. So this employee rate reduces on the 6th of January 24 rather than the 6th of April 24. So it really only gives, you know, sort of 6 odd weeks for anybody running a payroll to implement this change and be ready for it, which is not very much notice. So it'll be interesting to see how the payroll software houses deal with that. So if you're a higher rate employee, this gives you a saving of £754 per annum. So then turning to the self-employed, they pay national insurance at 2 different rates. One is class 2 and the other is class 4. Now, if we think back to the employee, as I said, if you're a higher rate earner, you had about £37,000 subject to 10%, and that would give you sort of full qualifying year. Now, originally, we just had class 2 and you paid a flat rate amount, and that gave you the same rights to state pension, for example. It was felt that it wasn't fair that the self-employed, in effect, got those rights at a much lower rate. So class 4 was introduced. So class 4, you pay as a percentage based on earnings falling within that band that we pay class 1 in. Class 4 has been a bit of an anomaly and has always been known as a stealth tax because whilst it is national insurance, it gives you no rights to contributory benefits. Now, one sort of important interesting point is that in 2015, the Office for Tax Simplification had a consultation and recommended that class 2 was abolished and the sort of access to contributory benefits was linked to class 4. Now, we've had no detail yet as to how the self-employed will retain access to these contributory benefits because that was referred to and confirmed on Wednesday. So it'll be interesting to see if the original OTS recommendations are adopted and it does become linked to class 4. Just as a reminder, the class 4 rate is also reducing by 1% rather than 2%, so it's coming down from 9% and profits in the band between 12,570 and 5270, and it's reducing to 8%. As Nicholas referred to, we've had the new rates for the national living wage, and I think, you know, as he said, for any employer with a labour-intensive workforce, in effect, this is an enforced pay rise for their employees. So it'll be interesting to see whether they will pass that on to us, the consumer. So for those aged 21 and over, the new rate is £11.44 per hour. For those aged 18 to 20, it's £8.60 per hour, and the apprentice rate for 16 to 17-year-olds will now be £6.40 an hour. Turning to capital gains tax, in the current year we have an annual exemption of £6,000 for an individual or a personal representative and £3,000 for a trustee, so that's no change. The capital gains tax rates are as we've had previously. Again, we've had no change there, and we do also still have the additional 8% charge on residential property. And following our sort of theme of not really many changes in the personal tax sphere, the annual exemptions are as previously announced. Turning to pensions, as Nicola sort of referred to in his opening remarks, we do have a lot more freedoms now. Potentially, we have no lifetime allowance, so in theory we can build up bigger pots. There is a cap on the amount of tax-free cash you can take, and that cap is set at 25% of the old lifetime allowance limit, unless you had applied for protection for your pension pot, and then you may have a different cap figure. Now, one thing that was referred to on Wednesday is that there's going to be a consultation opened in respect of individuals, you and I, having a pension pot for life rather than multiple pots. So if you have, say, 4, 5, 10 employments during your lifetime at the moment, you could, in theory, end up with that number of pension pots, which can become unwieldy to manage. Instead, the consultation will look at the practicalities of us as individuals having a pot which each separate employer pays into. Turning to pension contributions, again, the figures are as previously announced, and for the 24-25 tax year, there's been no change. So we're looking at a £60,000 annual allowance for an individual. If your adjusted net income exceeds £260,000, for every £2 excess, your £60,000 allowance is reduced by £1 down to a minimum of £10,000. Looking at inheritance tax, now despite the number of leaks which came out over the last few weeks, and obviously in the trust arena this is of particular interest to me, there were no changes whatsoever. Whether we'll still have the same regime in a spring budget, who knows, but for now it's as we were. So we still have the same nil rate band at 325, same residence nil rate band at 175,000, and the taper threshold for the residence nil rate band, which that starts to go, is 175,000. So making tax digital it's been sort of trumpeted in the press for many years now, and we've had lots of announcements about it saying it's come in, and then lots of sort of pushbacks on that and delays. It was due to start April next year, but that has now been pushed back to April 26. It's intended to come in from April 26 for all of those with gross profits and rental income combined totaling £50,000, and then the following year from April 27 that limit reduces to £30,000. We are currently in the transitional year for the basis period reform, which links to making tax digital. Just as a reminder, the basis period reform will make the vast majority of self-employed businesses, so sole traders and partnerships, have an accounts year end which aligns with the end of the tax year. So at the moment you could have a situation, for example, with a business which has a 30th of September year end, and let's say that business has been running for many years. For the 23-24 tax year, you will include the 12 months results to 30th of September 23, and then you'll also add in the 6-month result up to the end of the tax year. So in effect, you are taxing 18 months of profit in one tax year. The trade-off there is that if this business has been going many years, it may well have something called overlap profits. And this is where at the beginning of the business, an element of profit will have been taxed twice. However, if the business has been going on for some time, then it's highly likely that those overlap profits at the beginning are probably going to be a smaller figure than the extra 6 months we're going to add on at the end of this tax year. We can deduct those overlap profits, which will give us an element of relief, but I don't think it's going to be enough to negate the effect of that 6 months. So people need to be thinking about this now and planning for their tax cash flow payments. We've also got the practicalities of, if you've been in business for some time, can you find your records that have got your overlap relief? So continuing with the Making Tax Digital announcements that we had, the original plan had been that you would have to provide a quarterly statement of your income and expenses in that quarter. So let's say we're done Q1 for the year, you came to Q2 and realised that you'd got a figure wrong in Q1, for example. Previously, the intention had been that you would resubmit Q1 and then do Q2. We're now changing so that the plans are, it will be a cumulative quarterly statement. So let's say you got to Q2, realised that something in Q1 wasn't quite right, you just correct it in Q2. So that would be much easier. Now, it's anticipated that everybody will have MTD compatible software, so you shouldn't need to do an end of period statement, but you will still need to make any adjustments for sort of accruals, prepayments, anything like that we need to think about. There will also be simplifications introduced for landlords of jointly owned properties, so we're not having, onerous reporting requirements in respect of expenses, for example, so we'll need to wait to see the details on that. And finally, foster carers and those without a national insurance number will be exempt from this regime. And then turning to ISAs, sort of tax-free savings wrappers, there's going to be an extension to the range of investments permitted, so that should give investors a bit more freedom on that. There's also going to be digitalisation of reporting, so investors will have more tools to monitor their investments. You'll now be able to invest in multiple ISAs of the same type in 1 year. So open, for example, a share ISA with 2 separate providers, if that suited you. And there's also the intention to sort of update the ISA platforms, so it's easier to move between providers more easily, which should make, more incentive for investors to use it, I think is the aim there. So certainly if these changes look attractive to you, then I'd recommend you speak to your financial advisor to see how they can help you. So that's the end of my run through on the private client points of the budget. And I'll now hand over to Christine, who will cover the indirect taxes.
Thank you, Rebecca. Just sharing my screen. I'm slightly disappointed that I don't have a Star Wars film slide intro like Nick did, but that was amazing, our marketing team, thank you very much. So I'm going to start just talking about cash basis. There are very few indirect tax measures that were introduced in the autumn statement, but I'm then just going to run through those as well. So cash basis, this was something that the Chancellor announced, and it has been something that taxpayers have been able to access in terms of drawing up their accounts each year. For rental businesses, it's been the default for a while, although you can opt into what's known as the accruals basis. So I'm assuming there will be a few non-accountants on this webinar this morning. So I will just explain the difference between cash accounting and accruals accounting. So in terms of a cash basis of accounting, you're basically, as the name suggests, you would be accounting for cash that comes into your business and cash that goes out of your business. So you wouldn't be taking any account of, for example, money that's owed to the business, so invoices you may have raised and you're waiting for money to come in from your customers, and you wouldn't take any account of any money that you owe your suppliers because they've issued you with an invoice and you got, say, 30 days or 60 days or however long to pay that invoice. So on a cash basis, it's straight cash in, cash out. You would also not make any adjustment for stock. So because you don't make any adjustments for stock, if you are a business that makes goods or sells goods in the retail sector, you're likely to be holding quite a lot of stock, and there's likely to be a mismatch there between the goods sold and the cost of those goods sold. So the default generally for businesses is accruals accounting, but you have for some time been able to use a cash basis, and it often suits the smaller self-employed businesses. And just to run through what the current rules are before I move on to what the change is. You can use the cash basis at the moment if you run a small self-employed business. So it is only for trades, it is only for unincorporated businesses. So you'd have to be, for example, a sole trader or a partnership. If you have a turnover of less than £150,000, then you can access this cash basis of accounting. This does, I don't think, coincidentally align with the flat rate scheme threshold for VAT, but it is something that is a simplification that was introduced a number of years ago to just make it easier for those smaller businesses to do their accounting without a lot of support from professionals. If you do have more than one business, you currently have to use that cash basis for all your businesses, and the combined turnover in that scenario of all the businesses must be less than 150,000. If you are using the cash basis, you must currently revert to accruals basis when you reach a turnover of 300,000. So at the moment, you can opt for a cash basis, but a cash basis may not always suit the business. So if we look at some of the more detailed rules, you can't currently claim interest or bank charges that are more than £500 as an expense if you're using the cash basis of accounting. As I've already stated, if you're a business that has more complex requirements, for example, you hold high levels of stock or multiple lines of stock where you need to be accounting for those, then it's probably not really for you. And you've also got to think, you know, it's not just for tax purposes that you're drawing up a set of accounts. So if a bank, for example, wants to see your accounts, then often they will want to see those accounts drawn up under traditional accounting methods, under what we call generally accepted accounting principles, where the receipts are matched to the purchases. So that would be the accruals basis. The other restriction within the tax rules is that if you do use a cash basis, then you can't use the result that gives in terms of profit or loss to make any sideways loss relief claim. So you can imagine a scenario, particularly in a startup business where there's been a lot of expenditure and probably very little sales. If a lot of that expenditure has been for stock purchases, for example, you would normally adjust those if they hadn't been resold. But if you're on a cash basis, you wouldn't need to adjust for those. So you could quite easily create a loss on a cash basis of accounting. So there has been a restriction that you can't then set that loss against other income in the year. So what's the change? Well, the change is from the 1st of April 24, the cash basis will now become the default position. So this is similar to rental businesses. Rental businesses is generally classed as investment income unless you're a furnished holiday letting business. So that has been the default position for rental income for quite a number of years, but you can opt into the accruals basis of accounting. Now this will be the same for the self-employed and trading partnerships. Again, not companies. Companies have to use accruals accounting because they have to give a true and fair view their profit under generally accepted accounting principles. But for sole traders and for trading partnerships, the default position will now be the cash basis, but you can elect to use the accruals basis. Now, whether you would do that will depend on a number of factors. And those factors have now changed. So what was limiting previously is now not going to be limiting for you. So the £150,000 turnover limit has been removed. So basically your turnover can be as high as you like, and you can use the cash basis. The restriction for bank interest or charges of more than £500, that's also been lifted as part of the autumn statement proposals. And also, quite astonishingly, the removal of restrictions for losses that you want to sideways relieve. I say rather astonishingly, what we do lack is any detail whatsoever in terms of how you're going to be able to do this moving forward and whether there will be any restrictions around this. Sorry, before I move on to the VAT threshold, as I stated earlier, there may be businesses where this just will not suit you, and obviously if the bank need a true and fair view position, then they're going to insist on accruals accounting, especially if you're borrowing a lot of money from the bank. Why they've done it, simplification is probably one of the reasons. Making Tax Digital, which Rebecca mentioned earlier, is looming April 2026. So one of the areas that Making Tax Digital for income tax will bring in is this need to be quarterly reporting, so along similar lines as you do for VAT. So partly wonder whether the quarterly reporting for most small and some medium-sized businesses, they wouldn't do full accruals accounting on a quarterly basis. Some businesses will, but most businesses will be doing that accruals basis at the year end. So it is going to make the reporting that HMRC get quarterly look quite different to the year end on an accrual system. So whether that's part of it in terms of aligning. The ability to switch, as I've already outlined, there is quite a wide scope for manipulating the results from one year to the next. Overall, it's only ever going to be a timing difference, but from a tax planning perspective, timing differences can make a significant impact on your tax liability. So my anticipation would be that switching between one and the other, there must be some regulation around that, whether that would just be viewed as pure legitimate tax planning or whether they might introduce some anti-avoidance legislation around that. At the moment, you can switch, well, you have to switch if you get to a £300,000 turnover level, and you would have to make adjustments on the switch so that you're not, double counting or getting double relief for any expenses. So there's a little bit more detail I feel that we need around that, but it is something that is coming in from the 1st of April. I anticipate most businesses won't change, but it'll certainly be something that we would be looking at from a tax planning perspective once we've got a little bit more of the detail come out from the draft legislation. Moving on to VAT, there were no announcements in relation to the movement of the threshold or the movement of the rate of VAT. Likewise, as some of you know that have been watching these webinars for a while, I've been monitoring 4 other countries, and their appetite for any change is zero as well. They've not moved any of their thresholds or rates of VAT. VAT registrations, I did get quite excited when the Chancellor announced some investment into HMRC resource, because one of the areas where resource, or what we're being told by the senior people within the VAT registration teams, is that resource is their restricting factor, and that's why we are experiencing considerable delays in getting VAT registrations through for business. From the 13th of November, now all applications must be completed online unless you're digitally excluded. We did raise this with HMRC at a recent event that I went to down in London, because one of the reasons we often can't file electronically is that one of the other HMRC teams, the corporate tax team, haven't issued a unique taxpayer reference, and that is required in order to apply for VAT registration. So one is impacting the other, and in order not to delay the VAT registration application, we do often put paper returns in. So I think they will still accept paper return. Digitally excluded usually means that you're excluded based on, you know, the fact that you haven't got internet, or you're in a poor Wi-Fi area, or you know, you've got some sort of religious objections, or are fairly elderly and not able to use computers. But there are other reasons why we can't always file online for the application for that registration. So the delays continue. HMRC did update us at the event I went to the other week to say that 80% meeting their target levels has now risen to 90%. But then when you consider that their target is to turn a VAT registration round in 40, well, it says 40 days, but they actually mean 40 working days, which is 8 weeks effectively, so 2 months for businesses. You can imagine the sort of issues that's creating for businesses where they haven't got a VAT number. You can't contact them anymore. They closed the helpline down. So on the VAT registration side of it, you can contact the general helpline, but that will get you nowhere if you're trying to chase up a VAT registration. So you can't even follow up within that 40 working day time frame. You've got to wait for that to finish before you can then email them. And then they promise to get back to you within 5 working days, but we're often waiting 2, 3, 4 weeks for a call back. There are still issues with the IT, although that is improving. We've had a few incidences where, although everything has been registered and a number has been issued, they can't make that number go live. So we understand it's an issue with their legacy system. So if you were to look on the VAT checker tool, the number wouldn't be there, which is just no good if you're trying to import goods into the UK, because that's the system everybody uses to check that you've got a valid VAT registration and a valid EORI number to get goods into the country. So that is causing significant problems, and we are escalating those issues to whoever will listen. The MP was the last one that I sent for a business that is really struggling over the last 8 months to import into the UK. And theirs was a group VAT registration. They went from a single business registration to a group registration. And then my excitement at the extra investment was turned into disappointment when I realised that the investment was going to be in debt collection, with a more targeted and tailored approach to collecting debts rather than actually tackling the problems that we've got with more fundamental parts of the VAT system. One of the announcements was around gross payment status reform. So those businesses that are construction businesses will be familiar with CIS, the Construction Industry Scheme. up until now, in order to not get a income tax deduction from the payments you receive from your customer, you had to apply for gross payment status, and for that you had to show that you were compliant across the taxes, but you didn't have to show you were compliant with your VAT. That has now been included as one of those taxes you need to be compliant with. So CIS businesses will be familiar with VAT. There's been a lot of changes in relation to VAT over the last few years with the introduction of the domestic reverse charge. So businesses should be aware of what the compliance requirements are from a VAT perspective, but it's just one more hurdle you've got to jump through to get that gross payment status, so you can receive payments gross without any tax deduction. They've also extended HMRC's ability to remove you from that gross payment status for all other direct tax heads where there's a case of fraud as well as VAT fraud. Just a brief update on import and export declarations. The HMRC have been migrating to a new system, the customs declaration system, for a little while now. For imports, that was all switched off quite some time ago on the old system, which was affectionately known as Chief. And for exports, it was all supposed to be switched off by March this last year, March 23. They extended it last autumn statement to November 23, which they are meeting for high volume declarants, but the migration for everybody else will be delayed until 30th of March 24. So you've got a little bit longer on the old system before you've got to move over to the new system. But I do understand that one is going fairly well, certainly a lot better than the VAT registration IT infrastructure. Taking back control post-Brexit, you may think this was all done and dusted and dealt with back on the 1st of January 21. It wasn't from many legal perspectives. We moved from being subject to EU law under the EU Withdrawal Act 2018, and then we went into a 2-year period from the 1st of January 21 through to the 31st of December 23, where we've been governed by the EU Withdrawal Act 2018 and also the Taxation Cross-Border Trade Act 2018. From the 1st of January 24, there is new legislation that is currently being enacted called the Retained EU Law Revocation and Reform Act 2023. We did get an update from this at the event I went to the other week from, I think it was Jeremy Wolf, a member of the King's Council, who was just looking at it from a VAT and excise perspective. Most of the VAT and excise law has been assimilated into that Reform Act. There will no longer be any reliance on the European Court of Justice. But if you've got ongoing disputes, you've potentially got 3 periods there to consider if you've got any ongoing disputes or cases with HMRC. So there may still be some reference to the European Court of Justice judgments. So you may need to look back at earlier period law and precedents that have been set. But the general principles remain relating how the tax is actually constructed. But EU law will no longer take supremacy in relation to VAT and excise. Last couple of slides just on indirect taxes. For a couple of years now, probably a little bit longer than a couple of years, but I've only got a couple of years up there for business rates in order to try and help businesses generally during the COVID period the England standard multiplier for business rates has been frozen. That has been now increased for most businesses, apart from the small business multiplier, which the Chancellor announced he would freeze again for another year. Other areas, fuel duty. Now that all these duties increase automatically by RPI on the 1st of April 2024. I've got a question mark next to fuel duty. As with last year, there was no announcement made. So as things stand at the moment, and as the OBR forecast, it will increase by the retail price index, but it has in the March been subject to announcement that it won't be increased, and I think that's been ongoing for about 12, 13 years now, that there's not going to be any increase. And I think it would be surprising if fuel duty did increase on the 1st of April. Bearing in mind Nick's comments earlier regarding inflationary pressures, because that does impact both consumers and businesses significantly. Vehicle excise duty, that will go up with RPI. There is an exemption that was introduced for Ukrainian vehicles entering the country, which was an exemption that lasted 6 months. In the statement, that's been extended to 36 months, which aligns with what the majority of the working visas are being granted for now for Ukrainians coming into the UK. Plastic packaging tax. So this is a tax for manufacturers and importers of plastic packaging, and to be classed as plastic packaging, you need more than a 50% content of plastic. And then there's various reliefs for recycled plastic as well. The objective of this is to try and reduce plastic packaging, but also where plastic packaging is used, to encourage the use of recycled plastic. So that will go up by RPI. Tobacco duty escalator is 2% plus RPI. Hand rolling tobacco duty rate was increased from 10 to 12%. And alcohol duty was frozen last year to August 23, and it's going to be frozen again this year to August 24. Specifically a measure to try and help out the pubs and leisure and hospitality sector. And final slide, tax avoidance and fraud. There will be a doubling of prison sentences now for tax fraud. The maximum sentence was 7 years. It's now gone up to 14 years, obviously targeting most serious forms of tax fraud. And the autumn statement also introduced criminal offences rather than civil penalties, although there are still civil penalties in force for promoters of tax avoidance schemes, particularly where HMRC have issued orders to stop promoting a tax avoidance scheme, and those orders are going unheeded. So I think that sums up everything I need to say in relation to indirect taxes. As I say, there wasn't really much in the way of announcements. So I will now hand over to Matthew Appleyard, who's going to tell us about what was in the budget on corporate taxes. Thank you, Matthew.
Good morning, everyone. Start again. After a firm announcement that nothing was going to happen in terms of tax, we certainly had a roller coaster of hinted changes in the week leading up to the actual autumn statement. We went from IHT being abolished to income tax rate cuts, and finally 110 growth measures or changes actually announced. I'd like to thank Nick, Rebecca and Christine for taking you through a few of those changes so far, and I'm now going to take you through the 84 final changes that we've yet to discuss. So I hope you've got yourself a strong cup of coffee, strap in, and let's get this thing on the road. A poor joke, but I do try. Have no fear. I'm not going to go through 84 different changes. I'm going to canter through the few changes that were actually announced in relation to the corporate and business taxes. We'll be taking a focus on research and development changes, given the huge change in landscape in that area over the last 12 months with the increase in R&D inquiries. So let's actually dive in to the few changes we'll discuss this morning, and hopefully we'll get you away pretty quickly. So I'm going to start off with a reminder. Many would have not gone through their first year end yet with the changes to corporation tax that happened from 1st of April 2023. So profits made up to £50,000, you're still in the 19% corporate tax rates. Profits between 50 and 250,000, you're into a marginal rate of tax, and profits over 250,000, you're into that higher rate of 25%. These limits are reduced for short accounting periods and for associated companies. So just a reminder what an associated company is. If one company has control of another, both companies are under the same control of the same person or group of persons, then they are associated. We talk about minimum controlling interests when we talk about groups of people. A close investment holding company, they can't claim the small profit rate. So if you are a company that is just investing, it's likely you'll be up at the 25% tax rate. So what does that look like? Well, on the left, this is what it used to be. What it is rather. So we'll now be up to 9,500 for 50,000. Well, that hasn't changed. All the way up to £250,000 worth of tax at £1 million, so up £60,000 from where we were previously. And for those wondering, yes, I did calculate £1 million at 19% on a calculator, just in case. The increase represents a real cut to a company's ability to reinvest. And so it's more important than ever to ensure that we're maximising reliefs from this tax where possible. So we'll go through first capital allowances. So full expensing, it's here to stay, it's permanent, it's the best I think in the EU according to Jeremy Hunt. So what is it? Well, it's 100% relief for new and unused plant and machinery only. So those items qualifying for main rate pool expenditure. Now I say plant and machinery only, but that does include things like computer equipment, etc. For items like solar panels, which continue to be a big investment area, and I know I've mentioned it a couple of times now as we've gone through these sorts of budgets, these are special rate pool items. Now, full expensing is available for special rate pool items, but at a much lower rate. It's at 50%. The balance of the 50% will then go into your normal pool and qualify for writing down allowances at a rate of 6% per annum. Full expensing assets sit outside of your general pool. So the drawback to it is that when you sell an asset, which you've claimed full expensing on, you'll be required to bring into charge a percentage of those proceeds, depending on what pool it would normally have sat in. So if it's a main pool item, 100% of those proceeds will be subject to corporation tax in the year of disposal. For special rate pool items, 50% of those proceeds will be brought in, and the balancing 50% will be a disposal from your special rate pool. So if you do have a pool, it will just reduce the value of your tax written down allowances going forwards. Just as a reminder of the extension to the 100% first year allowances for electric charge points. This goes through to 31st of March 2025 for corporation tax and 5th of April 2025 for income tax purposes. This is to ensure that the tax system continues to incentivise businesses to invest in the charging infrastructure. So research and development, first hinted at in March 21, later more widely in the autumn 22 statement, as Jeremy Hunt noted that we move a step towards a simplified single RDEC-like scheme for everyone, simplified is a strong word. Well, following a very short consultation in January 2023, we are merging. I'm going to merge the current large research and development expenditure credit scheme and the R&D SME schemes together for accounting periods beginning on or after 1st of April 2024. I'm going to go through some numbers in a minute in terms of what these actually look like for people. As I said, this is aimed at simplifying and improving the system, but we're yet to see. One of the worries that we as professionals had in relation to the merging of the schemes is what actually happens to subcontracted R&D. So in brief, SMEs, or those that are claiming under the SME scheme, can claim costs of some subcontracted R&D at a rate of 65%. Those that fall under the large R&D scheme under RDEC, they can't claim subcontracted R&D. So it was vitally important we knew what was going to happen so that we could assist you guys, our clients, in budgeting for that. Well, it was confirmed that the government will legislate to allow subcontracted R&D to be claimed under the new merged scheme, but a subcontractor themselves cannot make a claim for R&D tax relief. So it's really important that the contracts between yourselves and your subcontractors, or if you think you may be a subcontractor, are robust and ensure that they know who the parties are, who are the people that are undertaking the R&D and will profit from that R&D, and where the IP, the intellectual property, lies for that completed R&D work. It's been announced, and it was in fairness previously announced, further support for R&D intensive SMEs. Loss-making companies that are claiming relief will be eligible for a higher payable credit rate at 14.5%. The R&D intensity thresholds, so your activities, your costs that are in relation to R&D, to qualify for an R&D intensive company used to be 40%, or is previously announced to be 40%. This will now be 30% with effect from the 1st of April 24. And if you dip in terms of your costs, so you had 40% and then, or rather you had 30% and then you dipped down to 20% for any reason, HMRC are allowing you a year of grace. So you can still claim the higher rates of repayable tax credits for a one-off shock. Once you go through that year of grace, if you still can no longer meet the R&D intensity thresholds, then you fall back into the normal R&D tax reliefs. Nominee refunds. So just as a note, this one was mentioned quickly. Nominees can no longer receive your R&D refunds other than under very limited circumstances. HMRC will be paying the R&D tax credit, tax refund, back to the claimant company only. So we've seen those that are financing R&D activities, so lenders that would have otherwise received the repayment as part and parcel of the loan agreement through the refund. They're going to need to make alternative arrangements and may potentially end up carrying out further checks over their clients. HMRC's one-to-many campaign, well, I'm going to go through what that looks like in a bit, but effectively they're still inquiring, they're still nudging. Are you actually doing R&D? Do you need to be talking to your advisors? Do you need to be talking to us? And we've seen the inquiries from HM Revenue and Customs in respect to research and development ramp up pretty hard over the last 12 months. I'm going to go through what their inquiries look like and why we in particular are asking you guys more questions now when it comes to R&D. The compulsory notification of a claim, we're most of the way through that now. But just to confirm, if you've not made an R&D claim in the last 3 years, but you are intending to make one, you need to notify HMRC of this intention within 6 months of the end of your chargeable accounting period. That's now in, as I understand, and it's an online form. Similarly, if you're making a claim, there is now a form that goes alongside your corporation tax return, and in fact must be submitted before you submit your corporation tax return. And this effectively backs up the reports that most of you are already preparing, but nevertheless HMRC want it in their standard format. If you don't submit the notification to HMRC in advance of submission of your corporation tax return, HMRC systems will just effectively take your R&D relief out of your CT return and process your return otherwise in the normal manner. So your R&D claim will effectively immediately be denied. So what does the merge scheme look like? So this is really simple, guys, but ultimately I'm going to assume that it's a tax-paying company paying tax at a rate of 25%. Normally this company would have been under the SME regime, and I have amended for the enhanced deduction, which is now at 86 point something%. And when instead they'll be under the RDEC scheme at a rate of 20% going forwards. So you can see this particular SME, it's got the same costs, it's carrying out the same activities year on year. Previously it would have had CT relief, so a reduction in its corporation tax payable of 17,200. Now under the RDEC scheme, the merged RDEC scheme, it will have a net relief of £12,000, so £5,200 reduction. Something that this is quite a small claim for our clients, so obviously that will ramp up accordingly as your claim gets larger. So the compulsory additional information submission form. So this is the form that needs to go in front of your corporation tax return, as I was just mentioning. And this is meant to reduce the risk of error or fraud. I get it. I've seen some boutique firms that have just been submitting the figures, the R&D claims, with no backing up of what the R&D actually is. So HMRC have brought this in to try and ensure that everybody's thinking about what the R&D actually is and discourage those in the field from claiming that shouldn't be claiming or are being led perhaps by some more aggressive claimants. So again, broadly, what's the advance, description of the activities being undertaken, what outcomes are being achieved? This is quite simplified, and I'm going to go through an actual HM Revenue and Customs inquiry letter in a minute. So I'll have some dead air and dead silence because I won't read it out to you, but nevertheless, it goes into much more depth than the compulsory additional information submission form. And it takes a long time to respond. So what are we seeing with HMRC inquiries? Well, we've seen a few, but nevertheless, they are in depth. We would always encourage our clients to submit a full and detailed report that runs alongside your research and development claim. And as we have been doing, as have many other advisors been doing in the R&D area. However, HMRC are reading through. They have appointed a team of individuals that are not R&D specialists to inquire into R&D schemes. And what we're effectively seeing is that a number of claims that are legitimate are being challenged, some are being denied, and some are going through appeal. Our first response letter in relation to an R&D inquiry exceeded 54 pages to answer all of HMRC's questions. It was posted to HMRC 2 months ago, and we are yet to receive a reply from them. They are absolutely inundated, and further, they are now seeing the appeals process, and all it is doing is dragging them down in terms of their resource. An R&D inquiry is therefore not going to be quick. So I hope you can all see that. These are the first 2 of 5 standard questions that HM Revenue and Customs are asking. So, and as a result, we're asking you guys more detail. So not just an explanation of what the scientific or technical uncertainty is, we're going into what your response must include, and hence what we are including in our reports. So what's the baseline? What is the advance? How is this new? Have you done your research into what's in the public domain already? why can a competent professional not just turn up and say, yes, that's exactly how you do it? And if you haven't filed a patent, why not? Now, most of these are quite obvious. You don't file a patent because you don't want all of your IP to be in the public domain. But HMRC don't understand that. They sit in an ivory tower and they expect that all innovations will have a patent with it. So question 2, an explanation of what the uncertainties in the project were. What are the current technological limitations? What are the current practices? Why can't the current practices resolve the uncertainty? And so on. I'm going to go on now to the next questions. So details as to the specific methodology. Why the knowledge is not readily deducible by a competent professional. They're asking you to demonstrate that you are a competent professional in your field, or further, the employee that you have is the competent professional, and why. They're wanting your competent professional to explain why they consider the uncertainties are scientific or technological rather than routine. They want you to put all of this in layman's terms. Why? Because they are not R&D professionals. They are not technical professionals. These are a HMRC team that's been moved from dealing with self-assessment to now dealing with R&D, and perhaps in a year or so's time they'll be dealing with land remediation relief claims. They're following a set procedure. They need to understand it in layman's terms. And this is a new one. Well, please provide a detailed timeline for your R&D project. So they want to know what you're doing from inception, so the thought process, all the way through to completion. What have you been doing? And can you label what people were doing each time? Like I said, it's in-depth, it's complex, and we are, as a profession, only expecting to see more of these. I'm going to move on to culture and creative tax reliefs. These were announced previously, but nevertheless, I'll just canter through. So for accounting periods ending on or after 1st of January 24, the reliefs will be reformed to be refundable expenditure credits, which are mostly based on the R&D system right now. Expenditure credits are calculated directly from qualifying expenditure instead of being an adjustment to a company's taxable profits, which is what's under the existing regime. There will be 2 sets of expenditure credits, so audio-visual expenditure credits to cover the 4 existing film and TV schemes, and the video games expenditure credit as well. Video games, film and high-end TVs have a rate of 34%. And this is obviously just outside of what's in front of you. Animation and children's TV have an expenditure credit rate of 39%, with credits available from 1st of Jan 24, as I've said. Otherwise, these rates will slowly be reducing over time. As you can see, the non-touring theatre tax relief reducing to 20% from 26-27 onwards. The orchestra tax relief dropping to 25%. Museums and galleries relief dropping to nil. We're there, guys, don't worry. We're now into other. So this is just a catch-all. Investment zone program extension. So yeah, the investment zone program in England will be extended from 5 to 10 years, and 3 new zones have been announced in Greater Manchester, West Midlands and the East Midlands. The sunset clauses. So the Enterprise Investment Scheme and Venture Capital Trust schemes were set to expire after 5th of April 2025. The government's going to bring in new legislation to extend the lifetime of these reliefs to 2035, so by another 10 years. The EMI scheme changes, well, a welcome change to all advisors. HMRC are now increasing the time to notify them that a scheme has been put in place from 92 days to the end of the 6th of July, following the end of the tax year, which comes into effect from 1st of April 2024. Right now, we in particular are seeing an incredibly slow response from HM Revenue and Customs. In particular, if you've for some reason got to register a pay-as-you-earn scheme, that alone can take up to 60 days. thereby reducing your time frame in which you can notify HMRC about the EMI incentive scheme considerably. We ourselves have had to put a couple of appeals in to HMRC to get the EMI schemes registered, which they've accepted, understanding it's their own internal failures, their internal systems that have caused the slowdown, and hence this is really what's been driving the extension to notify them. And finally, annual tax and envelope dwellings, well, the charges are going to be increased by 6.7% from 1st of April 24, in line with the September 23 consumer price index. And as I promised, that's it. So there is no other news from me. I hand back to Nick Smith for our question and answer session. Thank you.
Thanks, Matthew, and thanks, Rebecca and Christine, for your presentations. Most informative. We do have 3 questions. The Q&A session now starts, and there's still time to submit another question if anyone's got any burning questions. I'm going to start with one for you, Rebecca, please, if I may, which was a confirmation. Actually, this question I think was written after my introduction and before your slide came up. But it would be helpful if you could just confirm the living wage is now mandatory and not optional, please.
Yeah, that's fine. So it's the 2 terms are used slightly interchangeably. You have to be of school leaving age to get the national minimum wage, and then it used to be age 23 to get the national living wage. However, it's from the 1st of April 24, workers aged over 21 or 21 and over, sorry, will be entitled to the national living wage. So it's slightly confusing, but I think basically if you stick to those rates, you'll be okay.
Great. Thank you, Rebecca. I have another one for you, I'm afraid, so I hope you're ready for this one. This is on ISAs, just to get you prepared. What are the extensions to the range of investment permitted under ISAs, and have fractional shares now been given the green light?
That's a very interesting question. There's no sort of definitive wide-ranging guidance issued yet, and I think that will probably be going out to financial advisors first rather than accountants. However, the general sort of, wording that we've seen so far is that the government does intend to permit sort of investment in certain fractional shares, and they're going to be engaging with stakeholders as to how this is implemented, on a practical basis. But the general aim is that it's where people want to be investing small amounts on a monthly basis, say £100 a month, for example. Some listed stock market shares might cost £90 per share. So it's, very difficult to build up a diversified portfolio. So I think the general aim is to help that type of investor get into the investing market. So it's a case at the moment of wait and see and keep in touch with your financial advisor for more guidance.
Great, thanks, Rebecca.
Yeah.
We have Christine, I've got a question for you, if I may, on the cash accounting. This is from our very own Keith Phillips, who's a business services director and specialises in agriculture. So it's got an agricultural bent to it. It's quite a long question, so if you concentrate and bear with me. So on the switch to cash accounting, assuming debtors and creditors are fairly equal, do you not get a deduction of stock? So, with a farmer who carries a lot of stock, would this create a large loss? Plus, if a person heading to sale, presumably selling their business, I think, where they are selling off plant that's likely to create a large balancing charge, would not a move to cash basis allow better control over when that profit is taxed? About timing, I think, Christine, if you could pick that one up, please.
Yeah, sure. No problem. Thanks, Keith. So just one thing I didn't mention on when I did my presentation was around there are certain businesses that cannot use the scheme. There is quite a long list. Farming businesses, they're not excluded, but farming businesses that have a current herd-based election or have a averaging election, so they're into averaging the profits, won't be able to use it. But other than that, there doesn't seem to be any general restriction for farmers. So having got that point out of the way, yes, you're absolutely right. If you are switching from accruals accounting to cash accounting, you will not have had relief for the expense of purchasing stock that you're still carrying. So you would do an adjustment to deduct that stock, which could, as you quite rightly say, possibly create a large loss, which was why I was heavily caveating the fact that we've got very little detail on this. And also on the balance in charge question that you had, it was balance in charges, wasn't it? So where you've got capital allowances, where you've had business expenditure and you haven't utilised all the capital allowance, then you would then put that remaining expenditure as a deduction against income. Apart from cars are dealt with differently under the cash accounting as well as accruals basis accounting. But yeah, this was my point really. I think it's open to significant tax planning opportunities, or as the government might say, abuse. So therefore, I am anticipating that once we get the legislation, there might be, some more rules around this. Obviously, it wasn't that significant when it only applied to very small businesses with low turnover. But if it's going to apply to any business, that there is opportunity there to manipulate figures quite substantially to your own advantage. In terms of, there are some of the businesses like Lloyd's Underwriters, mineral extraction type trades, betting and duty type businesses, managed service companies, waste disposal, and cemeteries and crematoria are the main ones that sort of jump out on the list currently. And it's not abolished those restrictions, and not that I saw anyway in the legislation. It is just the turnover, the bank interest, and the sideways loss relief provisions that have been relaxed. So yeah, watch this space, Keith. I'm sure we'll be having lots of conversations.
Well, thank you, Christine. Yes, more complexity in the name of simplicity, I think, it springs to my mind, and just goes to show just how complex our tax legislation is, and what a minefield it can be. Well, there are no other questions, so I'm going to wrap up now. It leaves me to do a few thank yous. Thank you, first of all, to our panel of experts, to Rebecca, Christine and Matthew. Thanks for your presentations and for answering those three questions at the end. I must say thank you to Will and the production team. If it wasn't for Will, we wouldn't be here, or if we were, we'd be speaking to a blank screen. So thank you, Will, for making all that happen. And thank you finally to all of you who've attended today. There will be a feedback form. If you apply by email with that email address, you will receive an email shortly. And I really would appreciate it if you could fill out that feedback form, give us some feedback on how we've done today and any improvements that we might make. And I wish you all a happy Friday and a lovely weekend. Hopefully see you for the March 2024 budget, which will be a proper budget. Thanks very much. Goodbye, everyone.